Welcome to the latest edition of Fundamentals. This time around I'm going to look at an actively managed member of our favourite funds list, Jupiter Asian Income. The fund's aim is to generate both income and capital growth over the long term. The focus on capital growth may surprise given the fund's name, but its very experienced manager Jason Pidcock has honed a well-defined investment process over his 2 decades in the financial markets. He aims to invest in well-run, high-quality companies that can consistently increase their dividends, with the view that steady hikes in the shareholder distribution will, over the long term, pull the share price higher. The fund mainly invests in shares quoted on Asian stock markets, which includes Australia and New Zealand, but excludes Japan. The portfolio is a high conviction one with just 32 holdings, and the current biggest investments include Macau-based casino operator Sands China, Korean technology giant Samsung Electronics, Taiwanese contract manufacturer Hon Hai Precision, silicon chip giant TSMC, and the Hong Kong-based Link Real Estate Investment Trust. Looking at the geographic split, the biggest country exposures at the moment are Australia, Hong Kong and Singapore at 25%, 22% and 16% of the fund respectively. And then if we look at the sector breakdown, industrials represent the biggest weighting at 19% of the £578 million portfolio, followed by real estate at 18% and financials at 17%. The portfolio is built bottom up, however, so the stocks are Jason Pidcock's real focus, and his current selections offer a dividend yield of 3.8%, which investors receive on a quarterly basis. The fund does come with an ongoing charge figure of 0.98%, so you have to pay for the manager's expertise. And for those who put faith in such things, it doesn't have a star ranking from Morningstar, but that's mainly because the fund's very young. It was only launched in March 2016. As a final point, the Jupiter Asian Income Fund is eligible for SIPs, ISAs and dealing accounts, and the minimum investment is just 1 share, which costs around 138p at the moment. So those are the mechanics. The question to address next is, why would investors consider buying the fund today? So here there are 2 possible reasons. The first is that meaty 3.8% dividend yield, which may catch the eye of income-seeking investors. That's comparable to the yield on the FTSE All-Share at the moment and currently beats cash, UK government bonds and the UK rate of inflation. The second is that Asian exposure can provide some portfolio diversification. It could be argued that the continent has better growth prospects than the West due to its better demographics and lower debt, while corporate governance is also improving. In addition, research from Societe Generale's investment bank shows that Asia is cheaper than many other regions' stock market options. Here we can see that Asia trades at a discount to most major other markets, even though forecast profit growth compares pretty favourably. However, the Jupiter Asian Income Fund may not be suitable for all investors, also for 2 reasons. The first is that Asia's underperformed over the past year, as we can see in this table here, although some investors may see that as a buying opportunity. The region is a huge play on global trade, and if President Trump's economic policies lead to a trade war and the impositions of tariffs around the world, then Asia is a possible loser, especially as China is the real cause of the president's frustrations. Hong Kong's already trading at a 10-month low, and in addition, emerging markets in general tend to do badly when the dollar's rising. That's because it makes it more expensive for Asian and other firms to service their dollar-denominated debts. Right now, the dollar's rising because US interest rates are going up faster than anywhere else. This chart shows a leading emerging markets exchange-traded fund, or ETF, against a dollar trade-weighted basket. In addition, this fund's underperformed its underperforming benchmark since launch, as we can see here. Now, 2.5 years is no time at all, and frankly an unfair test, but the fund is underweight technology, for example. So if the Chinese internet stocks and a lot of Apple sub-suppliers keep going bananas, or the expensive Indian market rises sharply, then the fund may keep lagging some of its Asian peers. Equally, the shrewd among you will have noticed that Chinese internet stocks have started to sag, as you can see in this final graphic, so you may not be too worried about this final point. What this does go to show is that investors must do their research on Jupiter Asian Income Fund to make sure it fits with their overall strategy, their target returns, time horizon, and their appetite for risk before they put any capital to work. Thank you for watching.